Trading futures and options on futures involves substantial risk of loss and is not suitable for all traders and investors. Oftentimes in futures trading, you have a high combination of leverage and volatility. And although this could be an equation for opportunity, it's also an equation for risk. So be careful. Only fund your futures trading account with risk capital. My personal definition of risk capital is money I could afford to lose, doesn't change my lifestyle, or overly stress me out. As human beings, we make bad decisions when we're under stress, so be in a good spot. Remember, micro contracts could be friends. Take it easy on the day trade margins. You get plenty of leverage without maxing out on those day trade margins on a regular basis. We'll be taking a look at a real-time simulated live NinjaTrader trading platform today, and none of this should be construed as trade or investment advice. Past performance not indicative of future results.
Well, good morning, good afternoon. Welcome to Develop Your Edge with Anthony Crudele. I'll be your co-host, Tom Schneider, CMT with NinjaTrader, and we have a great topic today coming for you. We're going to be talking about trading the weak market. That's W-E-A-K market. Not talking about weekly charts, the weak market. And without any further ado, let's bring in Anthony. How you doing, Anthony?
I'm doing great. Hope everybody is doing well out there. Today we were going to talk about the weakness in the Russell. And of course, today Russell's having a very strong day, but I actually look at that as an opportunity. I'm actually long some puts in RTY. I'll talk about that in a little bit. And I actually added just before I got on the show. So I have a short position on an RTY, and I want to really focus in on the divergence. I think that's the most important thing, because days like today do not surprise me in the Russell when you have this big rally, and then I can't see what S&P and everything's doing right now as I'm looking into the camera. But typically when you have these divergences, you'll have one market that's weak, obviously, because it's a divergence, and you have one market that's strong. And that's what we've seen so far this year. And it's been trending since January, where the Russell's just been a little bit weaker. I think it's down maybe 2-3% as of today for the year, while the NASDAQ is up anywhere between 3 and 4% or whatever the numbers are, right? So you had that divergence. And I think that a lot of people consistently look for that buying opportunity in Russell to catch up to the NASDAQ, or look at the market as a whole and say, well, why isn't the Russell participating in it? And maybe the NASDAQ's the one I should be shorting, because maybe the overall market isn't strong, or maybe I should be shorting S&P and looking for the divergence to pull in. And typically what I have seen, and I actually put a tweet out this morning and even last night about it, is that divergence typically, if it starts in January, it goes through January, February, and a lot of times into March. And so it can be really a difficult trading time in general. I think that February so far, I haven't really done very much at all, just because the divergence is difficult. And I'll explain a little bit more when we're in the charts, but I just know that I'm going to stay on the path of shorting the weak and trying to buy the strong. And you're going to get days like today where maybe the Russell's, outperforming NASDAQ and S&P, and it seems like, oh, maybe the low is in and the bottom is in. We'll see how they close today. But ultimately, these types of divergences create a lot of choppiness in the indexes. And I have just learned in general, and we're going to really highlight this today, that I'm better off just picking one direction of the market, trading it small. I've been saying small and smart all the time, whether it's in my Discord or whether it's on X, just because if I try to overthink it too much, I got myself twisted up a little bit towards the end of last week, or towards the end of the month of January. And I was like, man, I just can't believe I just got, I went from long to short, and I'm like, whoa, man, you got to step back here before this turns into a worse drawdown for you. And ultimately I said, when I started looking at it from 10,000 feet down, sell the weak market, buy the strong market. Don't think too much about it. Be small. Even if I have a few losses here right now, maybe I'll be wrong on the Russell being short, or I'll try to buy the NASDAQ and maybe that won't work out. We'll see. But ultimately, I'm going to keep it small and just try to go back to the process, try to go back to where the trends are, instead of trying to fight it and overthink it. And so today I really want to hone in on what I'm seeing in the tape and how I'd approach it.
That's great. By the way, if anybody has a question for Anthony, you can do so by going to the chat, ninjatrader.com/events. Just log in there, drop in a chat. You don't even need an email address. Just hit the play button. And if you have any questions for Anthony, feel free to drop them in. Mission Control, send them to me. Anthony, we talk about, we haven't gotten to the charts yet. Just maybe for a question for later in the show, is there, when you've got this bias of which one is weak, which one is strong, are you concerned about maybe what might affect why they're strong, why they're weak, or are you just focusing on the charts?
The charts first and foremost, but the Y in the Russell is going to be pinned to what's happening in the 10-year. So we're going to be looking at the ZN as well today because that's extremely important. The ZN actually, as I'm looking at, that's a chart I have up now. I was going to start with that, is going to be sitting at, and it's the lows of the past. Well, it's the lows for the session for sure. But when I look at it on a daily, the lowest we've been pretty much this year. We're almost on the lows of the year. We're not far off from that. And so when you look at it from that perspective, that's rates going higher, which is going to directly impact the Russell, which if you go back and look at what the Russell's done this year, every rally that the Russell has had typically has had a day where the 10-year is up. Not today. What is also interesting, why I stepped in and got short yesterday, Russell, was because you had a pretty decent move higher in the 10-year. And then the Russell didn't rally. The Russell actually broke. And then towards the close, it got weak. I'm going to be using options for this trade. I know that we're on NinjaTrader. They don't have options, but on Trade-Evade, you have event contracts. And I think on a day-to-day basis, what I like about event contracts, which I'll show the dome on those, because you actually can trade those on Trade-Evade, CME Group's $100 event contracts. It's a 0 DTE option. What I like about it is it's a fixed risk play. And so anytime that the market gets really choppy, or I think that there's a lot of, I hate the word uncertainty because I'm never truly that certain that the market's going to do anything. I've been wrong a bunch of times before. You know what I mean? It's just this uncertainty is something we live with because we're never really truly certain. I think it's more about the lack of confidence in trends. And so therefore I don't want to be too strong in any one position. I want to be leveraged long or short any one of these markets right now, which futures markets are obviously leveraged. So I'm really trying to take a smaller path of it right now. So this way, if I'm wrong, I don't want to be, getting beat up as much. So I like event contracts as well, and I'll explain why those matter. But to go back to your question, I know I said a lot there. Yeah, the ZN matters, and ZN's near the lows of the day. And this Russell rally today, I look at it as, a shorting opportunity. I mean, the futures could keep running a little bit here. It's why I went into options. It's also why I like the event contracts for today. I'll show you the strike I would pick going into the close, but we'll see.
Awesome. Awesome. And you mentioned event contracts. Now it's $100 event contract, not the 20 I think it started with.
Yeah, it's a totally different product, honestly, now. And, it's a product that was pretty steady with its growth in terms of volume for people trading the $20 contract. But I think this $100 contract, at least from the traders I've talked to now, have taken a look at it. And I think that it's a much better product. And
Oh,
I think
great.
it's a day tradable product now, which I think the $20 before, you could buy something at $2 or $4, it would go to 6 or 8, and you're kind of like, okay, am I going to cover this? You're probably going to hold for the $20. Now, when I pull the dome up in a little bit here, you're going to see how for the RTY, I mean, like right now, I don't know what the 1970s are trading, but that's the one I would look at. They might be trading anywhere between $20 and $30, but if they all of a sudden rip down to 1960 or 65, they can go to between $50 and $80.
Right.
So, I mean, just if you put out a 10 lot and risk 200, you could make $200 to $400 in an event contract and not even worry about the close. So it's really much more of a 0 DTE option that I think is very day tradable. If tradable is a word, I don't know if it is, Tom.
I think it is. I think you just made it if it isn't. Why don't we go to the charts? Because we're looking at this chart. Great chart right here.
Let's start off with the 10-year. So this is the premise of the Y, right? And does the Y matter? Correlations matter. Yeah, they unwind. Like today, maybe unwinding the correlation between the Russell and the 10-year in terms of maybe price. But ultimately, that correlation is still going to exist. As rates go higher, that's not going to be a great thing for the Russell, bottom line. If the 10-year starts making lows, if it were to have a steep sell-off today, which is already a decent sell-off-ish, right? But if it were to continue to push lower and make a new low for the year, hard to see a Russell that wants to hang on to that. This goes back to why I would like an event contract for a Russell on a day like today or an option, just because of that mere fact that the futures, everyone's kind of been short. They're getting above the daily VWAP. The thing can spring load higher and then ultimately come way back down later. I mean, it's one of those things where I think intraday trading right now has been a little bit difficult to manage risk with some of the slippage, right? We go from like a slow market to a busy market and then back and forth. So anyway, the 10-year matters. And when you look at it here, you have my daily Bollinger Bands. And what I'm looking at is I box everything out, as you guys know if you followed the show before. And so what I look at is anytime we're boxed out, and I use 30, 50, and 70% lines on a Fibonacci retracement, boxed around the Bollinger Band peaks. And anytime the Bollinger Bands get flat and they're 20-period, 3 standard deviation Bollinger Bands, that typically just tells me we're in consolidation or mean reversion. And so right now, we cannot get above this 30% line in 10-year, and it keeps hugging below the 5-day moving average, which is really a measly little 5-day simple moving average, right? And it can't even really get above it. It's at a few days above it and bang, right back below it. And the 50% line, which I think is really interesting, if it starts to push below there, which is in the mid 110s, in the 10-year, all of a sudden, I think you have potential to start getting range expansion lower down to 108 and change, which I think really changes the whole dynamic of this market. And so I think that really the levels that we're sitting near right now in 10-year are extreme importance, I think, for the entire market, because if they fail to hold here, I don't really see rallies holding in S&P, nor do I see them holding in Russell, especially. NASDAQ, I don't necessarily know that it's going to really bury the NASDAQ. The NASDAQ is so tied to the Magnificent Seven. Are they overbought? Yeah. Can they remain way overbought? Sure. I mean, I don't know that I would be shorting NASDAQ if the 10-year goes lower. But Russell, yeah. S&P, maybe. And so it just will depend on how the action is. So this is really an important chart. And also just think about it, everybody, this year. We just had Fed Powell in 60 minutes, right? We have this continuation talk of what market expectations are, right? If you go back towards December, basically the markets rallied, not necessarily, I would say that the Fed is going to be cutting rates. Obviously that matters because the amount of cuts were like up to 6 in the Fed funds. And I think that's tempered down to like maybe 3 now, 3 to 4 maybe. But ultimately the Fed even recently said, Kashkari even said, he goes 2 to 3, I think is reasonable, but I don't even know that that is at this point, but we'll see. But ultimately, expectations were that rate hikes are done. And that ultimately is what I think is more important than necessarily rate cuts. But, okay, if rates in the 10 years do start to inch down significantly, like we're at probably 4.17, 4.18 this morning, breaking out to probably a high of the year in yields, I just don't know that. And if the market continues to stay solid in NASDAQ and S&P, and I don't want to get into this to be in a rate show, but is it likely that the Fed, cuts as many times as people think, or do they not even cut at all? I mean, I don't know. I mean, but it's something to watch because this 10-year is really interesting to me. And so when you go to the Russell, so it's already sitting at 1975 right now. And when we get to a shorter term chart, I'll tell you a little bit why that's a little significant. Here's the 5-day moving average. And if you look at Russell, the Bollinger Band peaks and the market, the Russell's just been trending lower this year. It made a high in December, below the 5-day moving average majority of the time. I talked about Bollinger Bands, mean reversion or consolidation. That's where we're at. This market just does not look bullish to me. It looks sideways or potentially trending lower, right? Lower lows, lower highs, not a lower low here yet. We'll see. That's why I bought end of the month options. When you look at it from this perspective, it's like, could today be a day where it does change the trend? Sure, who knows? But we'll see how the market closes out the day. Once again, if 10-year stays weak, I don't see a rally sustainable in Russell. I just don't see it. Next, we look at NASDAQ, completely different market. This is the divergence, right? NASDAQ just looks bid. I would not short this thing at all. I wouldn't even look at a short. I would only look at longs. And when you look at, it's proving to me in every sense of the way that this market wants to continue to go higher. Would not be surprised to see 18,000 plus soon. And that doesn't necessarily mean that Russell will rally. I mean, it might ultimately, pull it up a little bit, but I just look at the NASDAQ and it's a completely different market. Above the 5-day, above this, my 30% level, consistently holds above the 5-day. Bollinger Bands are opening up like a mouth. We're in range expansion in NASDAQ. It's just not a market intraday I would even short because it just, all the momentum's to the upside, right? They're not done making a high. And so you have a divergence. And so maybe before I get to the shorter term chart back, maybe we just pull them down. We talk about divergence for a moment, Tom, because I think that this is such an important aspect of trading. When we have divergence in markets and indexes specifically, it's always going to cause a really tough, especially S&P tape. And you're going to see volatility come down. You're going to see volume come down just because confidence and trend. Like I said, I don't like the word uncertainty because I don't know that anyone's ever truly certain what will happen. But we have a lack of confidence and trend. You've got confidence and strength in NASDAQ. You've got S&P, which I don't even need to look at. It looks somewhat similar, but not nearly as clean. And maybe I have that up here right now. I don't know if I do, but I really want to talk about the divergence in NASDAQ and Russell. But the S&P is always going to be caught in the middle, just the way it is. even though Russell stocks aren't in S&P, the S&P is the broad market, and ultimately it feels a lot of different things, right? There's a lot of push and pull in it versus NASDAQ can just run because 7 stocks are going up. Doesn't matter what the other 93 are doing. We've already seen that, right? And so trying to fight that breadth or whatever you want to look at in NASDAQ, not a battle you'll most likely win. I've seen this multiple times in my career. I started in the mid 90s. It doesn't matter if the big guys are going up. I remember we used to sit there in the pit and just watch IBM or Microsoft. If whatever they did, the market did, they'd uptick, the S&P and NASDAQ would uptick, period. And so this is nothing new. This is not something that the machines have changed. This is the way markets have operated. So, getting back to how do we trade it, for me, small positions long NASDAQ, small positions controlled risk and shorting Russell, and using those blow up rallies in Russell to get short, and using the rip down breaks in NASDAQ to get long. I mean, why fade it? And I think that this trend could continue up until March, because if you look at any significant high, and this is not something that I have actually 100%, details on, but I know from memory, it's a lot of significant highs and lows are made in March, right? And I'm sure somebody can pull up some stats and say how that works. But I just know as a trader, January leading into February, very seldom does February change what the market's been doing, right? Very seldom does all of a sudden January is up 2-3% or down 2-3%, and February gives it all back. Very seldom. A lot of times February is continuation of January, and March is that month where maybe we start to roll off a top or roll off a bottom. And when you have divergence, talking about trading the weak market today, like with the Russell, trying to play that for catch up, like on days like today, sure, it looks like it's working, no doubt, and it might be good just for that intraday trade. It caught that one blip higher. But ultimately, when you look at the chart, this is a market that if I'm long up until here, I'm probably covering it. And you probably got to think that a lot of people that have been long are going, well, we finally got a good bounce in Russell. Do I want to take it off here? And so I think that trying to fade trends for the year in February are difficult. It doesn't mean they won't happen, but I'm going to stay small and stay within trends. So we get back to the topic of today, trading the weak market, which is the Russell. I use strength to sell because it's weak. I use weakness to buy in NASDAQ. And so I want to actually go to the Russell chart here, and I want to look at something. And when you look at the Russell, it's interesting. You look at where the start of the year, this is the start of the year. This is just the year in the Russell. This is just RTH. So this is not overnight sessions. And so it does look a little bit different, maybe if you have it up on all the sessions. And I want to show you just like something that I see on a regular basis is like the Russell tries to go higher on 2 standard deviations away from the regular trading hours VWAP. And every time it gets up above there, it just gets sucked right back in. I mean, it just keeps coming back down. And every time that we push lower, we've had a chance to break 2 standard deviations into 3 standard deviations. You saw it back here in January. You saw it back here in February. This is the month VWAPs. And when you look here today, we got near the 2 standard deviation from this month's VWAP, 1959. Yesterday, I saw a little bit of selling come in the close there. We squeezed up. Really, I mean, unless I were to start seeing a really push above 1982.70 or the year-to-date VWAP, you can't see that on here. It comes in at 1975 half, which we're black below. And that's if you pin it from the year to here on a daily chart. They keep coming up and coming off of these areas, and they want to spend majority of the time. The stronger trends come in below these monthly VWAPs. And so they're good guides. I mean, yesterday I took my shorts right when we were around 1959 where I bought the puts. Today I added some more when we were around 75 half. So my cost basis is between 59 and 74, we'll call it, right? So 15-point range. So somewhere in the high 60s on the average. Just because I know I can really control risk here. Getting above 1982.70 intraday today would probably cost me to puke them. But a daily close above 75 to 80 would also make me rethink it. But once again, small and smart. Use the strength in a weak market to sell the rallies. Use, even event contracts. I have this dome up. I actually want to see if I can pull this up here. So I was looking at this.
So Anthony, yeah. Good point about that. Today you're experiencing, which maybe you didn't really anticipate, but you're prepared for that rally to that second standard deviation band, still within your stops, still within your risk tolerance, but these event contracts can offset some of that risk by saying, well, if we close above this level, the risk, the event contract will pay me this amount.
Yeah, I
Zero
mean, this is
DT
where like
option.
an event contract becomes pretty interesting, right? Because they're all based on the close. And so I think that this is a pretty inexpensive. When I say inexpensive, I mean it's controlled risk. So I have to watch what I say there. It's not necessarily, nothing's inexpensive. You can trade as many contracts as you want on this. It's showing 20 up, but you mean you could obviously you can buy as many as you want, right?
Right.
This is the 1970 strike. And so I look at the 1970 strike as important because if the market starts failing from this 82 to 75 area going towards the close or intraday, I think we're going to keep finding that as resistance. And so this is $1 per tick, and you can trade these as if they're just basically micros, is kind of the way I look at it, because it's $1 per tick. And so you could buy it at 36 if you were to sell it at 50, if it were to get at the money. You'd make $14, just for a perfect example. Okay. But the risk is zero. It cannot get below zero. I know it says negative on here just because it has to on the depth of market, but it cannot get below zero. And so if you buy one at 36, it's $36. If you sell it at 50, you make $14, right? And so, but why I say that the event contract is interesting in these specific times is because I don't know how far that Russell could run before I think it comes back. So I think that at some point towards the close, it comes back again, because it's what's been happening on a regular basis. So if I like weakness in Russell, instead of just selling outright futures, I can buy an event contract put.
Right.
Okay, you can buy a call or you can buy a put. It's a yes or a no. But when you look at it on the depth of market, and you could trade it just like it's a future, but you're not using leverage. And it's a great way to me when I look at, if you're on Ninja or you're on Tradeovate, and I know that you guys don't have options on here, but you have this. And this to me is a great option because you have that ability to actually say, look at, or you could be long some Russell and buy some event contracts. Maybe I'll participate in this, but I'll buy the event contract out of the money in case this thing rips lower. I kind of have a hedge on. I mean, there's a lot of different strategies you could use, and these suckers will move, man. So I could tell you, I've been trading them a little bit here and there in the S&P. I haven't done any in Russell yet, but ultimately, when I look at these, I like these for like days like today. I also like them a little bit closer to the close as well. The reason is because when you get closer to the close is when you really could pick your strike better. You're right.
Right.
And the Russell strikes are going to be every $10. So I have the 1970 strike up here right now, but you can look at the 1980, the 1960, and you can see where those are trading. And so when you get closer to the close, they're going to be pretty volatile. And like I said, some of you might just even want to, you can scalp these. I'm not saying I recommend doing that, but it's not, you do what you do, you know what I mean? But these things are all going to be based upon that closing price. And I think 1970 is really interesting to watch today. As we get to midday, if I continue to see failures at 75-ish in the Russell, I might step in and buy some event contracts just for a day trade versus me trying to short it and putting a stop where I'd have to put above 82, where I might just, it's too much risk. I look at this and go, I could buy 10 and risk $370. Okay, it might be a little to some, it might be a lot to some. Nonetheless, you could buy one and risk $37. But if I'm right on a 10 lot, I'll make $730, right? Because I'm going to make 73 on top of 37, right? Or actually, it's 63, so I'll make $630. But to me, this is a much better approach when you get a market that the stop gets a little too wide. And even if I think it comes back to 70, most likely, so understand this, every time you get to even or at the money, it's going to be trading around $50, right? So this right now, this is out of the money. So if it gets back to 1970, which I think at some point it does today, because I think that the market's going to continue to have a little bit of weakness around this area, it's going to be trading $50. I mean, they're going to price it in there because that's at the money. At the money for these event contracts is $50. Out of the money is going to be below 50, and the money is going to be above 50, right? How much is going to be determining how close we are to the close. But ultimately, that is what I see of great importance. And so, that's why I like this product. I think it adds an options opportunity or an options option for those that are on Ninja and Tradeovate.
Well, and Anthony, you mentioned it before, but I think it's worth reiterating is you can't lose more than you pay, right?
Okay.
So you mentioned 370 you pay for 10 event contracts, and you expect the market to do this. But if it goes the other way and it just something happens, we don't know, your maximum loss is what you paid for it, not what the market may go to if you're using a futures contract.
Anytime I get sensitive with a stop, like I talk about the Russell again, why am I using options and event contracts for this type of trade? Because intraday, you could have a big squeeze move higher. And, yeah, I mean, I could try and play it long too, but I've already committed to trying playing it short. And so I'm going to sell the weak. We talk about trading the weakness in the Russell today. I'm going to trade the weak market to the short side. I'm going to use strength to get short. I mean, could I be wrong? Sure. But I've already made my commitment to what I'm doing. That's what I'm looking for. I mean, the Russell's proven time and time again. Anytime we get a move, 1 or 2 standard deviations above a monthly VWAP and continued to show weakness when the 10 year's been weak, I'm going to step in and get a little bit short. But it's going to be hard to manage risk in this environment. The stops are not great, because I get up here and if I just short futures at 73 to 75 or wherever we are right now, my stop's got to be above 83, period. And, I don't love that. So why not just be in some options or event contracts because I can manage the risk. If I'm going to be wrong, I'd rather be wrong something that costs me less than my risk reward is higher. That is the beauty of an event contract. Like now they're down to $30. So it's an easy math number. You buy one at 30. If it goes back to 1970, it's going to be worth 50. You make 20 bucks. You're making 2/3 of what your risk is.
Right.
Not a lot, that you can do out there, and I think in terms of a stop and make that kind of return, right? And so that's why I like these. And also, I don't have to worry about the stop. I already know the money I put out is the money I committed. This is a non-leveraged product, right? And so I think in certain instances, this product makes a lot of sense, right? If I'm scalping or trading directionally with the trend, I could obviously like futures much more. But if I think that the market has a chance to pull back on a squeeze day, or I think that there's going to be a squeeze into the close, or I think there's something that's going to happen and I want to be able to manage risk in that direction, this is a better option.
Awesome. Yeah, that's great explanation. We're running up against time. Do we have any other business to take care of, Anthony?
No, I mean, I also want to mention just real quick that, the CME Group also offers the micro Russell futures. And, there's multiple ways you could trade Russell. You don't have to just trade the RTY. There's the micro Russell, there's a Russell, and there's the event contracts all available on NinjaTrader and Tradeovate. And so I think that, you find what works best for you. And I'm going to say this again, just leaving on a note where you look at these markets when you have divergent tapes. Small and smart, everybody. I mean, look at, I'm the first to admit I got knocked around towards the end of January, beginning of February, not been the easiest. I'm sitting in a loser right now in the Russell, but I'm being small and smart, and I'm going to find my rhythm again. It is what it is. This business is about ebbs and flows, and you have to just accept that that's the case. So what I like to do is when the market's uncertain or I'm not confident in trends, trade smaller, get stronger hands in your positions. That means be able to get in a position to where if the market makes a sharp move against you, you're not just puking out, you're not too leveraging your positions and you're chasing it, and you get that anxiety and that feeling in your body where you're just, you're struggling, slow things down, small and smart. That's all I can tell you in this environment. It's a long year. And if you're doing great, great, awesome. Keep pushing. Push now, right? If you're doing great. If you're struggling, small and smart.
Awesome. Great advice. Appreciate it, Anthony. Just a little bit of a side note, the micro symbol on NinjaTrader is M2K. 2K stands for the Russell 2000. So the micro for the micro Russells, M2K. You can pull it up on your NinjaTrader charts, market analyzer, all that stuff. But thanks for that. That's great advice. And we'll do this again next week. Want to thank everybody for coming. How can they find you, Anthony, if they want to?
Just on X, I'm at Anthony Crudele. Of course, I have my Discord that follows up a lot of this stuff that I talk about and Develop Your Edge. And you can go to my link tree, which is on my X page, or go to anthonycrudele.com. I really recommend going and checking out the Discord. It's free. We have a great community in there. I follow up on a ton of stuff that I do in Develop Your Edge on in the Discord, and I put out a free morning note every single day that you can go and follow and get my ideas and what I'm looking at for the market. I've got some really cool stuff coming up, so hopefully you'll join us in there.
Awesome. Great. Thanks for that, Anthony. Thanks to the viewers for coming as well. We'll finish the day. Mike Burke's going to wrap everything up, and bars closing 3:15 Eastern. Hope you can be there, but in the meantime, have a great trading day.